What is the student loan tax bomb and what do you mean it's coming back? Well, the student loan tax bomb refers to the fact that student loan forgiveness can be taxable depending on the type of student loan forgiveness you receive. Now, the Biden administration in 2021 passed the American Rescue Plan Act, which made all types of student loan forgiveness tax-free, regardless of how you got it. So that included income-driven repayment plans, borrower defense to repayment, death and disability, all of it tax-free. However, that expires on December 31st of 2025. And in 2026 and beyond, certain types of student loan forgiveness may be taxable. What types? Well, first off, public service loan forgiveness is tax-free federally every day. Doesn't matter. However, Mississippi, I hate Mississippi. They do tax it statewide. Also, death and disability discharge is tax-free federally, and I think in every state. However, certain types of loan forgiveness, such as anything tied to an income-driven repayment plan, so if you're on IBR, pay-as-you-earn, or the new RAP plan, if you receive borrower defense to repayment or a closed school discharge, even things like bankruptcy discharge will be taxable starting in 2026. Now, that is taxable federally. I'm not even going to get into the state tax rules because there's a lot of them and it's very confusing. But you could owe taxes on the amount of student loans you have forgiven. And there's a calculation to this, and you could also not owe taxes on it if you're insolvent. And so we have a calculator here on the College Investor. Of course, you know where to find it, and it'll walk you through what you need to do. So here's an example of someone that has no taxes due. I'll get out of the way here a little bit. But if you have $60,000 in assets and $145,000 in total liabilities, $70,000 of that being student loans, you make $80,000 a year, you're single, you click calculate, and you are considered insolvent. No taxes are due. And the reason you're insolvent is the $70,000 in forgiven student loans is more than you have. And so the IRS doesn't make you pay taxes on that. Let me show you what partial insolvency looks like, or you owe taxes on it. And you still aren't going to owe that much, but let's take a look at what that looks like right here. All right, in this scenario, you see someone that has $80,000 in assets, $180,000 in total liabilities, $170,000 of that being student loans, $80,000 a year again, single. This person's considered partially insolvent. They're actually $100,000 in insolvency, and so they're going to have a tax liability here about 16,000 bucks. Sorry if that's at the bottom of the page there. But that's what you would owe when it comes to your taxes, which owing $16,000 in taxes is way better than owing $170,000 in student loan debt. And you can also set up a payment plan with the IRS to pay that out in chunks if you don't plan or save for it. So the tax bomb is scary for a lot of people because they're like, I owe the IRS money. This is scary. It's a lump sum. But that lump sum every day of the week is better than what you'd owe on your student loan debt, significantly better in most cases. And a lot of borrowers actually don't end up owing taxes because of insolvency. If your financial life isn't working out and you're never able to accumulate assets, well, guess what? Like, you probably won't have a lot of assets and you might not owe any taxes on that student loan debt. So it's really important that you understand that this is a thing. I wouldn't let it stop you. Getting loan forgiveness is always better than not getting loan forgiveness, even if you pay taxes on it. So keep that in mind, and this is what you need to know. Of course, hit the link in bio, like, subscribe, and follow, and we'll always bring you the latest on higher education and personal finance.